Welcome to Trading Nation. I'm Seema Modi, and we're talking about Apple. It's having an incredible month. Check out some of these stats. Its stock is up 16% since the start of August, in its best performance since early 2012, and it's added $142 billion in market cap. For context, that's the equivalent of Nike or IBM's entire market cap. Can its run continue? Matt Maley is with Miller Tabak and Chad Morganlander with Washington Crossing Advisors. Matt, first to you. What do you make of this incredible run we've seen in shares of Apple, and will it continue?
Well, it's certainly hard to fight the stock. I mean, it's interesting. We reiterated our positive stance on the stock back in May when it broke above its 2018 highs, and it's had a nice 20% rally since then. So we were kind of pounding on the table back then. We're not quite as bullish on the stock now, but at the same time, we're certainly not saying you should sell the stock. It was interesting. They had a comment in Barron's recently, about 2 weeks ago, talking about how it's not a technology stock, it's a consumer electronics stock. Well, maybe that's true, but the consumer seems to be doing pretty well, and so does consumer electronics. So I don't know that's the worst thing in the world. However, the stock has gotten a little overbought on a near-term basis. It's not reached the extremes it's seen at major tops, but it has seen that. You look at its weekly RSI chart. It's getting to levels where it usually takes a breather. So, again, I'm not saying you should sell the stock or even stop buying the stock, but I think if you want to be more aggressive, you want to do it on any kind of dip rather than to chase it in a major way up here, especially because I think if we do finally see any kind of pullback in the market due to some of these other concerns, whether it be China or trade or whatever, that Apple could become a source of cash. So if you're going to be aggressive, I'd rather be aggressive on weakness than way up here.
And Chad, when we look at a company like Apple, it really comes down to earnings growth, but not so much on iPhone shipments. Services, of course, has been another big underlying driver of its growth.
Yeah, absolutely. And that, for us, is going to be the game changer over the next 5 years. If they're able to make services a larger piece of the pie, then they'll demand a higher multiple, because the service side of the business is much more predictable, higher margin business. Currently, right now, everyone's focused on ASPs and the actual cell phone sales, as well as their other eye products that are out there. But we believe overall you can get a market return out of this over the next 12 to 18 months. The one critical thing that Matt brought up that I think is 100% correct about is that this will be a source of cash if you start to see value start to outperform growth, or if there's a critical dislocation within the market. So we wouldn't be aggressive buyers at this point in time. Nonetheless, it's a great company, it's well run, and it's got a pretty bright future over the next 5 years.
What's your price target on the stock, Chad?
I would say a 6% total return over the course of the next 12 months. Market volatility with this company, I think, is going to be above average overall, because we believe that growth stocks, large cap growth, is going to start to slowly underperform value over the next 12 to 18 months.
And that continues to help NASDAQ's 8K run. Gentlemen, thank you, Chad and Matt. Thank you for joining us today and for watching Trading Nation. I'm Seema Modi. We will see you next time.
Hey traders, did you like that video? There's more where that came from. Scroll down and click on the links to the right of your screen. We publish new videos and commentaries from our experts every day. And don't forget to follow us on Twitter @Trading Nation.